back. So this video we are going to see about what is Forex market. So the previous video that we saw is about what is Forex. You would have seen the various basic events, activities between individuals or institutions that happen to create the Forex. So in this video we are going to see about how the Forex market is operating, how this Forex market is structured. So as part of this video, we'll go and look back into history and learn few historical events which caused to shape this current Forex market. We'll also get into the details about the various market participants and how they work together and how this market structure is set up. We'll also look into the various factors that influence the Forex market, the various business activities or individual activity which causes or influences the market to move. We'll also have a comparison or a perspective of comparison between Forex market versus the stock market. So let's get into the video. Let's again get back to history to know about the important events which shape the Forex market. It is important for a Forex trader to understand the history of Forex trading and the key historic events that shape the current market. This is because similar events could occur again and will have an impact on your trading landscape. So the best way to get prepared for those events is by learning what has happened previously, right? So remember, history tends to repeat itself. So let us be prepared for it. So we saw that the global trade started flourishing where people wanted to buy and sell products from different countries. So as an individual or as an institution, I would like to go and buy a product from another country. Right? So what I should do is go first buy the currency of the foreign country and then buy the product using the foreign currency. So this is a two-stage process when you want to buy a product internationally. So the first stage where you go and buy a foreign currency using your current currency. There is a challenge here. So why should the foreign entity who is issuing the currency, let's say a bank or an individual or any financial institution, why should they believe in our currency? So I'm giving my home currency. It's just a piece of paper, right? So how would a bank or any other financial institute believe or trust in the currency that I'm giving in? So the credibility of the currency is playing a major role in this transaction. So if a foreign institute needs to accept my home currency, then there should be a credibility to my home currency. So because of the challenge to build a credibility on the home currency, the trades were getting stuck. So only countries which are very well known were able to trade among themselves. Countries which were new and less powerful, less stable, they were not able to sell or receive products from better developed countries. So this is the challenge where a lot of countries started facing it. So this impacted the global trading system. This impacted the global development of an individual country. So how did the countries fix this problem? So what they did is they pegged all their currency against a common medium. So a common medium is something which is accepted by everyone in the world. It could be any commodity or anything that is accepted across the world, globally accepted across the world. So one of the common or globally accepted product is precious metal, which is gold. So all countries were recognizing gold as a precious metal. So the countries started pegging their currency against gold. So that is how a gold standard was formed. So where each country pegged their currency against a standard of gold, which means 1 unit of their currency will be equivalent to X amount of gold. So that is how gold standard started. So in 19th century, the major countries started adopting gold standards for their currencies. Almost all the major currencies were then pegged to a gold standard. So things were smooth in the trade and global markets because of this standardization. Then came the World War. So when the World War came in, most of the countries who were involved in the war were under the stress of economic collapse. So they needed huge funding to run their country, run their economies. So the only possibility they were seeing is printing money, which is in their control. So they kept on printing unlimited currency. So there was no meaning between a gold standard. So you don't have enough gold reserve to print so much of money. But still the countries were printing it. So the value of the gold was broken here. Around 1944, even the war was coming to an end. The major economies in the world at that time, UK and US, were very concerned about this system emerging, where you are printing money without a standard. So that is where this 1944 Bretton Woods system came into picture. So according to Bretton Woods system, the aim of Bretton Woods system was to stabilize the global economy, to restore it from the war and build a global economy back. As part of this system, the gold standard was reinstated back. This time, the difference from the gold standard era was adopting US dollar as a global standard for the foreign exchange. Other currencies were pegged to US dollar and US dollar was pegged to gold standard. As US was the powerful economy after the World War and controlled most of the gold reserves, US became a standard and US dollar became a global currency for all the trades. Though it was good for US dollar at that time, so later on, when a couple of decades, when the trade started flourishing, every transaction needed US dollar. So the necessity of US dollar started growing. So the value of US dollar started appreciating heavily. Even though it looks good for US, but the appreciation is not in favor of US because US dollar was pegged to gold. So the value of gold was going up. The demand for US dollar was going up in the trade markets and it was getting appreciated. Thus, US dollar became the most traded and powerful currency. As US dollar became the global currency, it was being used across all trades. This resulted in need of more US dollar in circulation. At a certain stage, US dollar was printed and circulated more than the gold reserve that US had. So let's say if US $1 is equivalent to 1 ounce of gold. Later when US dollar was printed more and more, so what happens? In the market, the value of gold appreciates and the US dollar value depreciates. For example, $2 might be equivalent to 1 ounce. So this is dangerous for US government because when somebody comes and returns this US dollar to US government is obliged to pay an ounce of gold for the US dollar. As an arbitrager, I could go to the market, I can get $1 go and give it to US government, get an ounce of gold, come to the general market, sell the gold for $2. So I make a profit of $1 and I can do this multiple times, which will ultimately kill the US economy. So this was a problem building for US. On the other side, the European countries were finding it difficult because of the heavy appreciation of US dollar in terms of trade. So that's where the Smithsonian Agreement and European Joint Float Agreement came in. So these agreements were brought in for the reason of reducing the dependency of US dollar in the trade and having a better trading environment. So though US dollar became a global currency and it was being completely used in all the global transactions, all the international countries have to settle their accounts in US dollar, where US dollar was pegged against gold. So as part of this system, so a country who's holding US dollar can go to US, hand over the US dollar and collect the equivalent US gold from US government. So in 1960s, most of the countries started redeeming their gold and handing over back to the US government. In 1966, non-US banks reserves were touching around 14 billion, whereas the gold reserve that US had was around 13.2. So where the foreign reserves were higher than the current gold reserve that US was holding. This started becoming a problem for US. On the other side, the European community also wanted to remove the US dependency on the trades. So they brought in Smithsonian and European Joint Float Agreements, which involved the trades without having US dollar in between them. Again, there was the same problem of pegging the currency with gold. Similar to Bretton Woods system, the new Smithsonian Agreement and the European Joint Float failed within a couple of years. By 1973, President Nixon wanted to pull away US against the gold standard, and he closed the window of exchange of gold with other countries on the US dollar. So this was the birth of Forex Market. So where the currencies were allowed to trade between themselves based on the demand and supply. So any currency can be exchanged with any other currency, where you don't have to value the gold standard and it is purely on supply and demand. This is how a forex market was born in 1970s. After this historical event of removing US dollar from the gold standard, so which left the market with three different paths. One, the currencies were on the floating rate, where one currency can be exchanged with another currency, and the rate can be determined based on the supply and demand. So this is a floating currency. Some currencies, some countries, they wanted to remain with US, and they still were pegged against US, and they continue to be pegged with US dollar. So these are called fixed currencies or pegged currencies. And there is the third bucket, which is called a currency basket. So when you introduce floating market, you have multiple currencies and multiple conversion rates, which gives you a confusion or uncertainty against the foreign exchange market in the trading world. So this would be solved with a currency basket, where you have a list of currencies and you give a weightage for each currency and the conversion rate for each of the currency. So your risk of foreign exchange is smoothened out. To just summarize, you will see three set of models that was born out of this historical event of removing US dollar against gold standard. One, bringing in a free floating currency rate where exchange between two currencies is volatile based on the supply and demand. And there are few currencies which are pegged with dollar. Even today's date, it is pegged with dollar, where you do not have much of a change. So the third one is a currency basket, where it is used for smoothing out the risk of currency conversion on a free floating market. So why do currencies want to be in a pegged state rather than being a free floating? So the major risk for a transaction or a trade between two countries is a foreign exchange risk, which means like there's a country which is selling to another country and expecting a payment. So if the payment is delayed by a month and the forex rate conversion goes against the seller, then he would lose all the profit in the foreign exchange. That is why the countries which often trade with each other, they get into a pegged currency mode, where fixed currency mode, where the currency exchange does not change much. So this will help the trading community to avoid the forex risk. When I say the trading community, it is not the arbitrage traders, it is the real product traders who sell and buy goods. So if you see a lot of Middle East currencies are still pegged with US dollar, and if you see Caribbean islands near US, they are still pegged with US dollars. The main reason for that is like most of their transactions, most of their income is through US dollars. So all these countries which have US dollar as their primary source of income or primary transactional volume, they still continued with the pegging of US dollar, because any fluctuation in the conversion rate will affect the profitability of a trade. So these countries, they continue to be remaining in pegged currency format. So it makes sense for a smaller country which is dependent on US majorly to use a pegged model. And it also makes sense for countries which have majority of the trade volume in US dollar or with US. So for those countries, the pegged model will work fine. For major economies like Germany, Japan, they would be like a global economy. It doesn't make sense for them to get stuck with a fixed rate with US. These kind of bigger economies, they try to be on free floating market. And that is why the free floating market is so volatile. So 1990s was the era of internet. Invention of internet made the trading to take it into a bigger level. So all those fund transfers and the payments or exchanges, everything was happening through electronic systems. So this helped trading to happen at a much faster rate and easier to calculate the supply and demand and able to calculate the volatility of the market, and it made all the trading world easier on in terms of the payments and receivables. So moving on to 2000. 2000 was the era for the retail brokers and traders. Technology advancement that we saw in 2000 made the retail traders to come into the picture. Once the forex trading was only available for huge financial institutions and high net worth individuals. After the advancement of the technologies and a lot of retail brokers coming in, So it was possible for even individuals. So now you can trade Forex with as simple as $10 in your account. This is how a retail trader came into the picture. Let's see the Forex market structure and the various participants who are involved in this Forex market. The perspective that you are going to see the market structure is from a retail trading perspective. So the first participant that you would be seeing is retail traders. Retail traders are the individuals from any part of the world who will be able to trade provided their local forex trading laws are complied. 80% of the traders are either new or less than a year experienced traders. This 80% of the traders comprise of newcomers, uneducated traders, and sometimes gamblers. The remaining 20% of the traders are professionals or a high net worth traders who have sufficient knowledge and training and experience in trading the market. So the next participant would be the retail brokers. Retail brokers are the brokerage companies who operate on multiple international locations. They provide the software and tools to the retail traders to help trading. A retail trader can go to a broker and open an account, deposit the funds, and start trading. Retail brokers create the infrastructure for you to deposit, trade, and withdraw your profit. They provide tailor-made accounts to suit your trading style based on your trading volume and deposit value. Retail brokers provide you high liquidity for your margin trading or CFDs, contracts for difference. Generally, brokers offer up to 1:500 leverage, where you will be able to trade up to 500 times of your deposit. Some brokers provide crazy liquidity like 1:2000. Though it looks good, it is a double-ended sword, so you have to cautiously use it. Most of them provide you free education, reading materials, and daily signals to trade. They will be registered in jurisdictions where forex business is legal, and generally they operate internationally. Some brokers are regulated by various regulating agencies from different countries. Some do not have any regulations. Choosing the right broker is the most riskiest part of the forex market. Though you have to be cautious about the brokers, we will also have to be thankful to the retail brokers. Without them, forex trading wouldn't have been a reality for retail traders and other related jobs in forex market. They have created various jobs like IB, introducing brokers, market analysts, automated trading software developers, and of course the traders. We will also have a separate video on how to choose your forex broker. Moving on, so the next participant is the liquidity providers. Liquidity providers are commonly called as LPs in forex market. LP is a financial institute or sometimes tier 2, tier 3 banks act as an LP. LPs are source of liquidity for the retail brokers. In other words, you can say retail brokers are the clients of LPs. Some LPs do allow individual accounts, but there would be a condition on your minimum deposits. LPs will be suitable for high deposit individuals, generally above $100,000. LPs offer leverage to retail broker, which is actually passed on to the retail traders. Generally, LPs do not offer more than 1:200. LPs do offer aggregated rate to provide better rates to the client. Aggregated rate is a rate which is arrived by receiving multi-bank rate and choosing the best rate out of the multiple sources. Moving on to the next participant, the tier 1 banks. Tier 1 banks are the top investment banks in the world like JPMC, Citibank, Barclays, and many more. 80% of the forex market share is held by the top 10 banks. These banks are the market makers and drive the rates based on supply and demand. These banks trade among themselves based on their client needs. Their clients include diverse businesses with forex needs. Banks are highly regulated by the government, regulating authority, and follow strict due diligence on their client. These banks are the ultimate liquidity providers whose liquidity is passed on to the LP and which is in turn passed to the brokerage and which is passed to the retail trader. The clients of the tier 1 banks who need forex services would be like government agencies who need their embassy services to be run and various other government related projects which is run globally. The other client would be hedge funds managing investments on behalf of high net worth individuals and funds group managing their investments globally. The other client would be retail banks and financial institutes. So their services would be like on credit card services, international loans, remittance services. Other non-financial MNC companies would be the client of the investment banking. So their sales and proceeds, which involve cross-border, they would need forex services on that. Companies will need forex on their operational needs, where salaries and other office expenses are transferred. Companies will need forex for forex risk management, like long-term payments to be protected, treasury management services, and investment management services. So now we should understand the difference between a market maker versus a broker. When a trader places an order to the broker, if the order is passed on to the LP, then it's a brokerage company. Some brokers do not pass on the trades to the LP rather than holding their client order. In this case, what happens? The broker becomes a market maker. So it is not something wrong to hold the trade, but it should be on a proper ethical way of processing the trades. Now let's see the factors influencing the forex market. So you can broadly classify the various events that cause the movement of forex rates into four sections, like global trades, international monetary activities, country development, and country events. So on the global trades, the imports, exports, sales and proceeds, business transfers, GDP announcements, these trigger the forex need, and in turn they trigger a forex rate to move. So if a country, let's say, is importing more, then it needs to pay to the country from which it is buying. So it is giving out its money. So the value of the home country would be going down. Similarly for sales and proceeds. So going on to the international monetary activities, so which involve international loans, government relief aids, World Bank policies, interest rate changes. So when there is a loan which is given by US to any other country, for example, let's say it is given to some developing country in Africa. So the US dollar is now changed to the African currency. So at this moment, there is a need of African currency. So automatically the value of African currency starts moving up because the buying is higher now. So the demand for the African currency is high. So the rates for the African currency will become higher. Similarly on interest rate changes. So when a country raises its interest rate, a lot of the financial institute banks, they try to park their funds into that respective country so that they can earn a higher interest rate. So the next one is on the country development. So which involves like infrastructure developments or real estate development. Let's say there's an MNC in UK and it sees India is booming in real estate. So they would like to enter into India and set up a project in real estate and proceed with that. So they would be pumping in money from UK, which is Great Britain pound. And when it has to be doing a business in India, it should be in INR, Indian rupees. So there is a conversion between GBP to INR. So where they are selling GBP and buying INR, which will create a demand of INR and which will shoot up the price of INR. So similarly, the other category is the country event, where the government policies or government election, wars and aggressions, unemployment, these all trigger sentimental wave, and these will drive the forex market. So all these events are just an example which cause a forex transaction. So when there is a forex transaction, automatically there is a demand for one currency and there is a selling of another currency. So the rates start moving. So these are the factors that influence the forex market, and it is not just limited to this. Now let's see a comparison between a forex market versus stock market. Forex is a decentralized market, otherwise it is called as a OTC market. There is no centralized exchange where the forex transactions are handled. It is handled between the banks and liquidity providers, and it can happen between any individuals as well. So that is why it is called a decentralized market. On the other hand, when you see on the stock market side, all the stock markets are centralized market which is regulated and which is an exchange based. So there is a body which governs this stock market. Generally it would be the government's regulation body. Forex market is 24/5 market. So the market opens around early morning in Sydney and closes by 5 p.m. New York time. There is no daily closure and open. It's a weekly open and closure market. Stock markets on the other hand are 5 days a week and have a fixed trading times per day. So they have an opening bell and a closing bell every day in stock market. Forex market is a global market, so it is operated by different entities, different participants, so at various locations. So hence Forex market is a global market. On the other hand, stock market is a local regulated market. The governments and the regulating bodies have a strong control over the stock market. Forex market is a highly liquid market which is provided by the top investment bank. So you don't run out of liquidity. If you want to buy euro or sell euro, whatever the quantity might be, you always have a liquidity in the market. But when you go to the stocks, you have a limited number of stocks where you can buy or sell. And it becomes terrible when the stock is plunging down, where you will not have buyers if you want to sell it. Or if there is an IPO released, you may not even get a stock allocation. Forex market is not easy to be manipulated because of the sheer size of market, and it is not owned by any individual body. So Forex market cannot be manipulated that easily. Stock markets very high prone to manipulation, scams. So stock market will need tighter controls to avoid manipulation. So to just compare the size of the market, so Forex market trades 6 trillion US dollar per day as a trading volume, which is compared to stock market as 80 billion per day trading volume. So now you can understand the sheer size of Forex market. So this 6 trillion can be classified or can be subdivided into 2 trillion in spot transactions, 1 trillion in outright forwards, and the rest would be on the currency swaps and options. So this is sheer size of Forex. The size of the market is formed because of the real business behind it, where you have a lot of international transactions. Every transaction will involve a Forex trading. So by now you should be knowing about the Forex market, how it was created and how it is operating now, who are the major participants of the market, and as a retail trader where you are fitting into this market, right? So if you have any further questions, please put down your questions in the comment section below, or you can find the email ID mentioned in the description and shoot out your questions to our email ID. We'll get back to you with the answers. Thank you.